What's up, everybody? My name is Ian Group, aka Ian Builds Wealth, and I'm a lawyer who loves to talk about personal finance, to take complicated topics and make them simple for you. So I'm back this week, and we're going to talk about paying off debt versus investing. Now, if you listen to personal finance gurus like Dave Ramsey, you'll hear him talk about how debt is the worst thing in the world. You should never have any debt. If you go to the other end of the spectrum, you've got guys like Grant Cardone who talk about how debt is king and they use debt for absolutely everything. And that's a pretty broad spectrum. And so I'm going to provide you with some information and numbers so that you can make this decision for yourself, because it ultimately comes down to what you want to do. We're going to run the numbers to show it. Now, before we dive into the numbers, let's talk about two types of debt: low interest debt and high interest debt. There's a big difference, and the numbers are going to show it. With low interest debt, we're talking about something around 2 to 6%. An example might be a mortgage, a car loan, even some student loans might be low interest debt. Now, on the other end of the spectrum, high interest debt is really anything 9 to 20% or beyond. When you think of high interest debt, credit cards and personal loans are absolutely high interest debt. You might have 0% interest offers or whatever, but generally speaking, those expire, and your credit cards are going to be really high interest, as are personal loans. But I just gave you a couple ranges of what low interest and high interest debt is. And what I want to do is provide a benchmark for you to be able to make that decision as to whether something is low interest debt or high interest debt. And one benchmark that you can use is the average return you can expect to get on your money if you invested it. Because if your debt and the interest you're paying on that debt exceeds the return you could make on that money when it's invested, you're going to be losing money. So the benchmark we're going to be looking at is the S&P 500. That's an index of the 500 biggest companies in the United States. On average, the S&P returns 7% per year. Now, you could see sometimes it's much higher or lower, but on average, over time, it's 7%. And that's why time is such an important factor in all of this when it comes down to investing, and especially comparing it to whether you would invest versus pay off debt. And in the next chart, I just want to prove to you how important time is, because when we zoom out and look at the chart of the S&P 500, you could see there are peaks and valleys, but it pretty much goes up steadily across the years. This is why a long-term approach to investing is really important, and it's going to play a key role in what we discussed today. So now that we know the difference between low interest debt and high interest debt, and we understand there's a benchmark that we can use to make the decision as to whether we should pay off debt or invest, let's go into the numbers. All right, so here we are. We're going to go over a payoff versus invest scenario, and I've actually got a few scenarios for you, but let's go over some assumptions quickly. So the assumptions we're going to make are that we have two debts. We've got low interest debt, mortgage of $20,000, which has a 3% interest rate. And we have high interest debt, a credit card, $20,000 of debt at 12% interest. So we're going to go over three scenarios here. In scenario one, I'm going to show you the effect of just paying the minimum payment on the debt. And the minimum payment on the debt is $250. In scenarios 2 and 3, we're going to tweak the assumption just a little bit. So even though the minimum payment on each debt is $250, my whole debt / investing budget is $500. So I have an extra $250 every month to play with. And since we're going to see the effects on investing, I told you this before, we need a long-term horizon. We're going to look at the effects on investing over 20 years. So in scenario 2, we're going to use that extra $250 that I have to pay more than the minimum payment on the debt. The monthly payments will be $500. And in scenario 3, we're going to make minimum payments on the debt, but we're also going to prioritize investing. So while I'm still paying off the debt, $250 will go towards investing. And then once the debt's done, the whole $500 will go towards investing. So let's go to the next slide. So in scenario 1, we are looking at minimum payments on the debt only. The low interest debt is going to take 7.5 years to pay off, and it's going to cost us just over $2,300. Compare that to the high interest debt, which takes almost double the amount of time and costs 10 times the cost of the low interest debt. So this is a really big difference. Low interest debt, $2,300, over $20,000 that you're going to pay in interest on the high interest debt. And this shows us in the numbers that all debt is not created equal. The higher the interest, the higher the cost to you. And when you look at these numbers, you start to realize that when you buy things on credit cards or high interest personal loans, there's a huge long-term impact. Okay, we're at scenario 2. And remember, I said before that we have some extra money. So even though the minimum payment on the debt is $250, there's this extra $250 that we have to play with. And in this case, before we invest, we're going to put all of that money, that $500, towards the debt. If you ever need to refer to the numbers, I've got all the assumptions on the top right corner. So let's look at what happens to our low interest debt. For both the low interest debt and the high interest debt, that extra $250 a month is huge. You can see here, we will pay the debt down, the low interest debt down in 3.5 years. If we go back to this slide before, it was 7.5. And note, in the scenario where we're just paying the minimum, high interest debt gets paid in 13.5 years. Well, in the second scenario where we're putting more money towards the debt, now we get it paid off in 4.3 years. So that's tremendous. And you can see the outcomes here. We make out about $16,000 better when we invest after we pay off the low interest debt. And that's really just because you get more time in the market for all of that money than you do with the high interest debt, because it's taking you a little bit longer to pay off. However, the high interest debt situation here really isn't too bad. You prioritize that debt, paying as much as you could towards that debt, and then you still wound up getting it paid off faster, and you still have a pretty substantial amount of money invested after 20 years. So I would say these are both kind of a win, even though you make out better in the low interest debt scenario. So this is scenario 3, where we are going to invest and also pay the minimum payment on our debt. So what does that mean? $250 will go towards the minimum payments on our debts. That extra $250 will go into investing. And then once the debt gets paid off, that debt payment will then go towards the investments. So then at some point, we're going to be paying $500 a month into our investments. But when does that point come? Well, now we're basically back at scenario number 1, because we're paying the minimum on the debt. So we have the original time periods that you saw in scenario 1, which kind of took a little bit of time to pay off these debts with the minimum payment. This is where it gets really interesting. For the low interest debt, we wind up doing better than any scenario. Paying the minimum and investing simultaneously works out in our favor, and actually about $1,500 better than had we prioritized the debt and then investing. But for the high interest debt, we wind up doing worse than in any other scenario. And it's over a $34,000 difference than prioritizing that high interest debt and then investing. So really significant difference here. And I think that this is totally eye-opening for our conclusion. So let's look at the rankings of how everything worked out. The best situation by far was for the low interest debt, when we both paid our debt and invested. So this is proof right here that you can invest while paying off your debt. The second best situation was, again, the low interest debt scenario, where we prioritized the debt and then invested. And look, the difference between 1 and 2 is only about $1,600, but we still wind up better when you pay off debt and invest at the same time. But that's really with low interest debt. With high interest debt, the game is a little bit different. When you prioritize your debt for high interest debt and then invest, you still fare pretty well. But if you try to pay off your debt and invest at the same time with high interest debt, it's a big loss compared to the other scenario. And then I put number 5 here as minimum payments only, because I think if you're not investing, you're losing out on a lot of compounding interest. Thanks so much for watching. I really appreciate you being here, and I hope this video added some value for you and that you could now answer the question for yourself: should I be paying off my debt or should I invest? If you like this video, please share it with your friends, like it, subscribe, leave a comment. I greatly appreciate it, and I want to hear from you. If you have any questions, leave them below, or you can DM me at Ian Builds Wealth on any of the socials. I'll see you again next week with another video. Remember, make smart decisions today to be rich tomorrow. See you later, future millionaires.